Welcome to The Way of Wealth. I'm Corey.
And I'm Lily. Corey, the financial markets are in turmoil today. Gold and silver both plunged hard, and our comment section is full of listeners asking the same question. Are gold and silver crashing?
Today was certainly the most violent session we've seen in months. Let's start by laying out the facts. London gold broke below $4,450 an ounce, falling more than $100 in a single day, and posting the lowest afternoon fix since the first trading day of the year. The cumulative loss for the week is nearly 4%.
What about silver? Silver usually falls even harder.
Exactly. Silver futures sold off to around $71 in early trading, and the spot price briefly broke below $69.50, the lowest level since late March. In this week alone, silver is down more than 4%.
Losing that much in just a few hours. So, what actually triggered this wave of selling? Did something happen in the Middle East again?
This time, it was the exact opposite. The trigger wasn't bad news. It was news that was unexpectedly good. The May nonfarm payrolls report from the Bureau of Labor Statistics. The market was expecting 85,000 new jobs. The actual number came in at 172,000, double the forecast. Even more striking, April was revised sharply upward from 64,000 to 179,000, and March was revised up as well. The unemployment rate held at 4.3%, and wages grew 3.4% year over year. In the entire report, there was almost nothing for the market to hang its easing hopes on.
Wait a second. Strong jobs data means the economy is strong, doesn't it? Why would gold and silver crash on that?
You've hit the key point, and this is the most important thing to explain clearly today. In a normal world, a strong economy is good news. But in today's fiat currency system, good news becomes bad news. Strong employment means the Federal Reserve has room to keep rates high, or even hike further to fight inflation.
And higher rates are the most direct headwind for gold and silver, which don't pay any interest. No wonder the selling hit the moment the data came out.
Right. Holding gold and silver earns no yield. The higher the returns on dollar deposits and treasuries, the higher the opportunity cost of holding metal with paper money, and short-term hot money flows out. After the data release, the 2-year Treasury yield jumped about 10 basis points in a single day, and the dollar index strengthened alongside it. According to CME interest rate futures pricing, the odds of at least one rate hike before December have surged to around 58%, exceeding the combined probability of a hold or a cut. In other words, the market's main script has flipped from a rate cut this year to a possible rate hike this year. That 180-degree reversal is the single biggest source of pressure on gold and silver.
58%! I remember not long ago the market was still debating when the cuts would start, and now it's actually betting on hikes?
That's been the biggest turning point of the past 6 months, and the key figure is the new Fed Chair, Kevin Warsh. When he was nominated at the end of January, the market went through a violent wave of selling. Gold began retreating from its all-time high above $5,600, and silver fell almost straight down from its peak of $116.
Is Warsh that different in style from his predecessor, Chair Powell?
Very different. In the later part of Powell's term, the market kept expecting him to kick off a rate-cutting cycle. Warsh, on the other hand, has long been a famous hawk. He has repeatedly and publicly criticized excessive central bank money printing and argued for higher rates to defend the credibility of the dollar. So after he officially took office in May, the entire market's rate expectations flipped from waiting for cuts to not ruling out hikes.
I see. So today's decline is really a continuation of that correction that began in late January.
That's a fair way to look at it. Do you remember the flash crash in mid-February? Gold broke through the psychological $5,000 level in just 30 minutes, bottoming out at $4,900, while silver plunged 10% in a single day. That flash crash wiped out hundreds of billions in paper wealth. At its core, it was a massive deleveraging event. Money that had chased prices higher with borrowed funds was forced out at any cost.
Like a chain reaction, where one stop loss triggers the next.
Exactly. The margin system in futures markets makes declines self-reinforcing. Prices fall, brokers issue margin calls. Those who can't pay get forcibly liquidated. The liquidation selling pushes prices even lower, and that triggers the next round of margin calls. In a market with this much concentrated leverage, once that cycle starts, it has nothing to do with fundamentals anymore.
No wonder you can never find any fresh bad news during the fastest part of a crash.
And today, it wasn't just gold and silver falling. US stocks opened lower as well. Global equities posted their worst weekly performance since late March, and treasury prices fell too, sending yields to a 2-week high. Simply put, stocks, bonds, gold, and silver were all being sold at once. This kind of everything down market usually shows up when investors are being forced to reprice interest rates. The only thing standing strong was the dollar. But notice what kind of strength that is. It's strong in its exchange rate against other assets, not in its purchasing power. Filling up your gas tank doesn't cost a penny less.
What about oil? Did oil prices fall too?
Oil is still riding high. West Texas crude remains above $90, and Brent actually rose nearly 4% this week. Put all these pieces together. Soaring oil prices, stubborn inflation, rising interest rates, and yet strong employment data. This combination is looking more and more like the 1970s.
Oil rising, rates rising, but gold falling. It sounds to me like the market is afraid of two things at the same time.
Your instinct is spot on. The market is afraid that inflation can't be brought down, and at the same time, afraid that high rates will crush the economy and the debt load. That is exactly the stagflation script. For a central bank, this is the worst possible dilemma. Hike, and you pop the bubble. Don't hike, and inflation runs wild. There's a cliff on either side. The central bankers of the 1970s swung back and forth inside that exact dilemma, and the result was a full decade of runaway inflation.
But Corey, isn't the war in the Middle East still going on? The tensions around the Strait of Hormuz, Hezbollah rejecting the ceasefire, shouldn't all of that be driving safe haven demand for gold?
This is the strangest paradox in the market right now. Trump says peace negotiations are in their final stage, but Iran's foreign minister says the talks have made no real progress, and Hezbollah has rejected the Israel-Lebanon ceasefire proposal. There's no end to the fighting in sight. The Iran war has pushed up oil prices. High oil prices have pushed up inflation expectations, and inflation expectations have pushed up treasury yields and rate hike odds. So after going full circle, war has actually become a force suppressing the gold price. One market analyst put it vividly: what gold needs is for the war to end, not for the war to escalate.
That sounds absurd. War drives prices up and makes life more expensive for ordinary people. And yet gold and silver, the very things meant to protect purchasing power, get hammered because the central bank has to fight inflation. Who exactly is this system protecting?
I believe a lot of listeners share that frustration. Central banks talk about fighting inflation, but the root of the inflation is round after round of money printing over the past decade, and more. First, they dilute the currency. Then they use rate hikes to punish the people trying to protect their purchasing power. But this is exactly why we make this show, to help everyone step back and see the true nature of this storm, instead of being swallowed by the panic.
All right, then let's zoom out and take the longer view.
Start with one set of numbers. Even after today's plunge, gold is still up roughly 35% from a year ago. Silver is even more remarkable. It's up more than 100% year over year. In other words, even after a fall like this, silver has still doubled in a year.
That's true. Seen that way, today's drop looks like a pullback after a huge rally, not a reversal of the trend. But the experience depends entirely on when you got in. Someone who bought a year ago is still sitting on a double, while someone who chased the highs in January has had a brutal few months.
Now, look at one more indicator, the gold to silver ratio. At today's prices, 1 ounce of gold buys roughly 60 plus ounces of silver. Historically, during the monetary era, that ratio sat around 15-1. And even looking at modern mining output, silver is only produced at about 8 ounces for every ounce of gold.
Which means that even after 2 years of big gains, silver is still the undervalued one relative to gold.
And this is why we keep reminding everyone, don't let a single day's price action hijack your emotions. In late January, gold peaked above $5,600 and silver hit $116. That rally was clearly overheated, with huge amounts of leveraged money chasing the price. Then from April into May, gold kept testing support around $4,500. And today's jobs report effectively stomped on that support one more time. Warsh's nomination in late January flipped rate expectations, and the weak hands who had chased the highs with leverage were forced to liquidate, driving prices all the way down.
So what has fallen these past few months is mainly the paper price.
Precisely. One asset management chief investment officer, Aslan, pointed out that this sell-off wasn't driven by a sudden change in fundamentals. Inflation data didn't suddenly shift, and policy direction didn't reverse overnight. What actually broke was the assumption that safe haven assets will always stay liquid under pressure. In other words, what crashed was an overcrowded paper trade, not the value of gold and silver themselves.
Corey, you said what crashed was the paper trade. Can you expand on that? A lot of our newer listeners may not be clear on the difference between paper and physical.
Sure. One concept we emphasize constantly on this show. In the Western futures markets, every ounce of physical silver that actually exists may have 200, even 400 paper contracts stacked on top of it. The vast majority of traders are buying and selling nothing but numbers in an electronic account, with no intention of ever taking delivery of real metal.
So when those positions are built on leverage, a reversal amplifies the selling pressure by hundreds of times, and the paper price can collapse in a single day.
Right. But remember this. That price reflects panic in paper contracts, not the true scarcity of silver on this planet.
Then what's happening in the physical market? With paper prices falling this hard, has physical demand disappeared along with them?
Quite the opposite. Look at a few signals. First, the physical silver price in Shanghai has maintained a sustained premium over the Western paper price for months now, and at its peak, that premium exceeded 30%. Second, at the start of this year, China's silver imports hit an 8-year high, with industrial buying and private investment demand heating up at the same time. Third, starting January 1st of this year, China placed refined silver under an export licensing regime, and only a small number of qualified large enterprises can obtain export permits.
In other words, the East is scrambling for physical while the West is crushing the paper price. The same ounce of silver is living in two parallel worlds.
And it doesn't stop there. From December of last year through February of this year, the Shanghai Futures Exchange raised silver margin requirements more than 7 times, and some silver funds even suspended new subscriptions for a period. Officials kept trying to cool the market down, yet exchange inventories kept draining. And there's only one reasonable explanation for falling inventories: a relentless stream of physical buying from the public.
That really is how it goes. The harder the officials push down, the harder the public buys. What about the physical market in the West?
Look back at that historic plunge in February. Western coin and bar dealers actually saw record-breaking demand, with many popular products completely sold out. One report described it well. A historic price crash ignited historic physical demand.
Smart money treated the paper crash as a discount sale on physical.
Exactly. That is the divergence between paper price and physical demand in its most vivid form. The numbers on the futures screen are collapsing, while the line outside the bullion shop keeps growing.
Corey, has anything like this happened before? A gut-wrenching correction in the middle of a major bull market?
Yes, and it's a classic. In the great gold bull market of the 1970s, gold corrected from around $200 at the end of 1974 all the way down to about $103 in August 1976, a drop of nearly 50%. Plenty of people declared gold dead at the time. And then, over the next 3+ years, gold rose from $103 to $850 by early 1980, a gain of more than 7-fold. Even more worth noting, during that nearly 2-year correction, the real turning point wasn't some exhaustion of bad news. It was the moment the market finally accepted that inflation wasn't going to disappear on its own.
Down nearly half, then up more than 7 times. The people who gave up during that correction collapsed right before the dawn.
That's the lesson history hands us. To be clear, we're not saying today's market will necessarily repeat that path, and we never make price predictions. But the structural parallels are worth deep reflection. Back then, it was the oil crisis plus stagflation. Today, it's war in the Middle East plus an interest rate trap. What's the same is that the purchasing power of fiat currency is being continuously diluted.
So, in the face of this kind of violent volatility, what mindset should we hold?
3 reminders. First, be clear about whether you're looking at the paper price or physical value. Panic selling on paper cannot change the long-term structure of physical supply and demand. Second, Volatility itself is the signature of this era. The closer we get to a turning point in the monetary system, the more violent the market swings will become. Third, return to our original purpose. Holding physical assets is about protecting purchasing power over 5 or 10 years. Not about next week's quote. Quotes can deceive you. They get amplified by leverage and distorted by panic. But the weight of that ounce of metal in your hand will never lose a single gram.
When you stretch the time horizon out, today's panic may be nothing more than a ripple in the long river of history.
Well said. The market will always use its most violent moves to eliminate those who decide with leverage and emotion, and it saves the real fruit for those who see the essence clearly and wait patiently. The Fed's rate meeting is next week, and in our next episode, we'll track the latest developments before and after the decision.
Sounds good. That's all for today.
Thank you all for listening. See you next time. Bye-bye.
Bye-bye.